guys, it's Doc's Market Minute for Monday, June 22nd. Now, everybody wants to be a bear right now just because market's been going higher forever and everybody keeps looking over their shoulder looking for the next big one. As well as it doesn't help that we have all of these ads that are out there that are paid commercials for Dr. Doom out there saying that the world is going to collapse and go build a bunker. So for many, many reasons, a lot of people want to be a bear. So how do we kind of turn around our bias and start to look for bearish opportunities? Well, one way I would do it is to look for candidates that have already started working their way into a downtrend. And what you'll see from this is usually pretty well pronounced daily chart action coming up to a trend line and then failing at that point, right? And we also want to see the chart moving into a weekly downtrend that may or may not be already into a monthly downtrend. In this case, the monthly chart is not yet into a downtrend, but one ominous signal here on these moving averages, the red and the green moving averages are the 50 and the 200. This one has just fallen into what's called a death cross. So the 50 is crossed below the 200-day simple moving average, so this is a death cross. And so for Colgate-Palmolive, this one might be a good setup if it comes back up to, let me clean this up here, if it comes back up to this trend line. And then what we can do is, one big advantage to this is that when the price rallies back up to the trend line, then the implied volatility will drop, will be crushed out of this. So from a relative perspective, it should be relatively cheap, at least a lot cheaper than trying to buy something down here. And then what we can either do is, depending on whether the puts are really cheap, we can buy puts, or we can set up an expected move out of the money debit put spread, or a bear put spread. So the first thing I would see is whether or not there's a decent trend line that we can sell against. I think that really helps because it kind of frames in the battle for what's happening here, number one. Number two, it's got to fail at that trend line. You almost see the price coming up to this trend line and pulling away from that like it was a hot stove burning their fingers. So every time it comes up to this trend line, it's just a complete rejection. So this one's got a little ways to go. But for me, the first step is to look for stocks that are below the 50 days, cross below the 200, so that's a death cross there, and that there's an effective trend line that you can sell against. Otherwise, it is just much more difficult to sell positions or buy positions in a corrective market. Corrective markets, by definition, are much more non-linear. They make a lot less sense in terms of how their structure works. This is why everybody's a genius. Everything looks so simple in a bull market because everything's so linear. But then when things flip over into a bear, they become very non-linear, very unstructured, very, very difficult to trade. So this is just some structure that you can use to identify opportunities and give yourself a good framework to buy positions against. That's it for today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.